Today's information is, as this first slide says, it's a halftime report. It's an opportunity for me to share, as well as John and Greg as the portfolio managers at Uncommon Sense Investing, some insights as to what went on the first half of the year, and then also talk a little bit what we anticipate for the rest of the year, also moving into 2025. We always say we can't predict what the market's going to do, but it is good to know what's going on in the economy because there are indicators that, we like to monitor that can sometimes help us forecast at least what to expect. We can't control what's going on. We certainly don't make moves in the portfolio in anticipation of what we think is going to happen. But it's good to know where we're at to try to make educated decisions as managers, as well as to just mentally prepare ourselves sometimes. So I'm Sheena Hansen. I'm the one that is presenting today alongside our portfolio managers at Uncommon Sense Investing, John Berkeley and Greg Snyder.
Good afternoon.
Hello.
Thanks for chiming in, guys. As we are highly regulated, I've got our disclosure slide here. Just a reminder, investment advisory services are offered through Uncommon Sense Investing, a registered investment advisor. We do not provide tax legal advice. And any kind of indexes mentioned in this seminar are unmanaged and not available for direct investment. And of course, past performance is no guarantee of future results. So again, welcome. Thanks for joining us. If you do have any kind of questions or comments during today's presentation, just hit the question and answer box that you have available to you and type in your question, and we'll be able to answer that either right away or a little bit later on before we conclude. So this is today's agenda. We're going to first be reviewing the first half of the year, January through the end of June, what happened in the US markets. Then we'll move on to talk about second half outlook. Talk a little bit about where we are now, what are the concerns, what's going on currently, and then finally, we'll talk about what's ahead. At the very end, I'm going to have John and Greg talk about what we've been up to with portfolio management and really hear from their words. All right, so here we go, a review of the first half of the market. So what went on, I think if anyone's been paying attention to their accounts or if you open your statement, you might see that the market has been going up. The S&P 500 as measured, that's an index that people largely follow in terms of performance. It's been a fairly strong year. So really in February 1st, there were the CPI reported inflation at 3.4%, which is lower than what it has been. That's been positive for the markets. The Federal Reserve later on in the year had signaled possible rate cuts. That is really a theme you're going to notice today that we talk about is this concept of interest rates. That's really been key in driving markets. The GDP, gross domestic product, so how corporations are doing, increases by about 1.6%. So that again has aided in, positive market returns. And then, just recently here in May, the core inflation measure has slowed down. It's the most recent measure has been the lowest that it's been in the last 3 years. So a lot of good things going on this year. And, we've seen that with market returns as well. John and Greg, I don't know if you want to comment on this or anything else as it relates to performance.
Well, Greg.
Okay, I didn't know which one was going to go. Yeah, I mean, for the most part, the CPI, has been coming down. The latest reading is 3.3%. 8% on it. So the inflation is coming down, but it's kind of come down and started to plateau, and we need to get it down. I know, it seems like the markets are really looking for it to get below the 3% before, the Federal Reserve is going to probably think about cutting rates. So we'll have to see what happens from there.
Absolutely. Yeah. I emphasized inflation and interest rates. Those are two big themes and drivers for what's been going on in the markets. But another theme is AI enthusiasm. So AI is in our world, as we know, and companies are jumping on board with the prospects of how it can make them more efficient. And that's also been a market driver. Another thing I want to mention is within the S&P 500, there's about 10 companies that is really driving returns. And so, it is worth mentioning that not everybody, depending on how they're invested, is receiving S&P 500 performance because the returns are so concentrated within a handful of companies. So yes, things have been positive. Yes, things have been good, but there is that, I guess, focus on certain companies, and that might not be totally relevant for all areas of the market or all accounts, depending on how you're invested. We'll talk a little bit about our value approach, and John, we'll hear your comments now.
Well, the CPI, the hardest part, the stickiest part of getting inflation down is where we are right now, the last percent and a half, to get it down below the 2% target. And the reason is that you have lagging indicators like labor unions and things like that are trying to get their income or their wages up because of the past inflation. So it becomes somewhat sticky. And also keep in mind, when we talk about CPI, if CPI or consumer price index declines, that doesn't mean prices are going down. It just means that the rate of increase is going down. Just so a lot of people understand that inflation numbers coming down does not mean prices are going to likely come down. They will not.
Yeah, no, that's an excellent point to make. But all in all, in summary, the first half of the year has been pretty good. You might have heard the term Goldilocks economy. That basically means that things have been moving forward, not too fast, but not too slow. So we've really been moving along. Let's dive into the second half of the year and what we might see participating and happening in the economy. I like this visual here. I don't know if anyone who's tuning in has seen something like this, but it's called a speedometer. It measures visually how good things are in certain areas of the economy. So kind of to figure out and gauge where we are today, I like to take us back to maybe where we were. And as this shows, this is back in January of 2022 when COVID concerns were pretty much gone, or at least, not heightened at all. We were past that. The green indicators on the speedometer indicates that we're in a good place with those indicators. Yellow is more neutral, and red is negative. Those are concerning for the economy. So back in January 2022, things were looking pretty good. Green light on almost everything, just neutral. We've only got 3 neutrals speedometers within the equity valuation, geopolitical risk, and the political environment. So it was really a good time for investors. Now, if we fast forward 2 years, January of 2024, it's a much more guarded market environment, should I say. We don't see one positive speedometer on here. Every area, most of them are either neutral, kind of a neutral impact on investing, And then we had a few actually negative, kind of more of a red flag for investors. And those three were equity market valuations, geopolitical risks, and the international economic outlook. So, really kind of concerning for the most part as we start out the year. Where we are today on those speedometers, it's gotten better. About a third of them have shifted into a positive territory. Those being consumer sentiment, so people are feeling better about where we're at economically speaking. The labor market, the housing and mortgages, consumer spending. Some of these big key indicators are in a pretty good place. Another third are still neutral, and then the red, more negative indicators that are still hanging out there are equity evaluations and geopolitical risk. I know we've been concerned, especially the managers, for a while now about equity evaluations, and so we would agree with where a lot of these speedometers are pointing right now. And just going through what we talked about, these indicators from January of 2022, January of 2024 to today, it just tells you too how quickly things can change and how also we really can't predict. We don't know. It was pretty grim looking in January of 2024, and it actually ended up being a pretty positive first half.
And it looked pretty good at the beginning of 2022. And it ended up being a major down year. So much for trying to predict the future.
No, you're absolutely right. These speedometers are gauges from professionals and surveys from people in our industry. And at the end of the day, we really don't know. So it's information to have. It's more or less food for thought, but absolutely not a predictor. So this chart here demonstrates, corporate earnings. Obviously, the stocks are based on corporate earnings and how things are doing from an earnings perspective. And the S&P 500, has pretty much followed the trajectory. It's been good. I don't really have much more to say, but it's been good. Inflation, again, the theme we can't underemphasize really is the fact that prices have been going up, but that's really cooled a lot. If we look back a year ago today, inflation was at about 4.1%, and really just kind of turning your attention to the more orangish yellow graph, the year over year rates. Today it's much lower, around 3.4%. It should be noted that the Fed has targeted to try to get it down to a 2% rate. We're not quite there yet, and it might take some time to get there, but we have not hit their target. The labor market, that's one thing that, really is another key indicator. What does unemployment rates, what do they look like? And unemployment remains at historically low levels. So that's yet another positive indicator, as well as job openings. They kind of remain elevated. So that shows us that we're in a pretty strong labor economy right now. Here demonstrates consumer sentiment. I commented earlier, how do people feel? There's that behavioral aspect of investing in finance that, believe it or not, does drive markets. If people are feeling good about the economy, their behavior is showing that. They're going out and they're spending. They're taking out loans for home purchases. They're doing various things. They're investing in the stock market. They're buying more stock because they feel good about what's going on, and that can continue to drive things higher. And here, just to kind of support what I had mentioned about AI enthusiasm, this chart, it measures the number of artificial intelligence or AI mentions on quarterly earning calls. And, that really has skyrocketed from years previous, ever since 2022, 2023. People are talking a lot more about AI, and we're just continuing to have more and more excitement around that. Okay, we're gonna move on more about talking about where we are now. Headlines, certainly we listen to the news. We see what's going on within our news feeds on our phones or social media. And it continues to be all the same things that I have mentioned already today. Inflation, interest rates, what's AI gonna do to corporate earnings in the stock market? Will the Federal Reserve be cutting rates? All of these things we don't know, but I do believe that's going to be the driving force how some of this comes to fruition over the next 6 months. So as we look out even further into 2025, all of these themes, in my opinion, and from what I hear from what I'm reading and other experts, is just going to be a continuation of what we've been talking about. There's been surveys, like I mentioned, of these so-called experts and forecasters. What do they think is going to happen in the next 12 months? And, the three major measurements of the U.S. economy are indicated here, being GDP growth, unemployment in 2025, as well as core CPE inflation measures. And those forecasters, if we look at what the majority of them are thinking is going to happen, they expect that GDP to be around somewhere between 1.5% to 2.5%. So similar to what's happening and what's going on right now. Unemployment to remain low, somewhere between 3.7 and 4.2%. So still at those very low levels. And then inflation to actually back down and go even lower, reduced to closer to that 2% federal target rate that the Fed is hoping to achieve. Again, this is all based on forecasters. We have no idea if they're going to be right or wrong, but it's kind of interesting to hear what the talk is, right? Key dates to kind of keep in mind if you are interested in potential rate cuts and what interest rates are doing. The Federal Reserve, they're going to be having their committee meetings as scheduled here. So at the end of July, we might get word on a possible rate cut, or later in the year, September, November, and December. So there's a few different opportunities for interest rate changes. Here, I couldn't help but mention the election coming up. That is one thing that we've been getting questions about a lot. And, as professionals, we know and we've seen in practice that presidential elections really historically, it doesn't have much of an impact on market returns. In fact, looking at these measures here, U.S. markets have generally gone up in election years. And so that's good. I don't know if there's correlation there. To me, I know that most years in the stock market, they are positive. And so that wouldn't be a surprise to me that election years that they continue to mostly be positive. Another data point here, data does not support that any theory that one party is better for market returns or not. So whether it be Democrat as president, Republican as president, similar, more kind of falling into what we would expect for market average rates of return. Interestingly enough, it does show here, if you look, the right-hand side of the chart shows, who's in Congress, the left-hand side, president. When there's a divided between Democrat and Republican, actually, it shows that historically there's been higher returns. So who knows if that's going to come to fruition or not. Any comments on the election, you two? John, I know you share opinions on that.
Well, I think that once again, with our basic fundamental strategy of investing and really everything that you've talked about up to this point, if we focus for the long term, and we are value investors, meaning that when we buy a position, we generally hold it for a very long time. Everything out there that could influence your decision to make a good decision, it can hamper your ability to manage money by taking you off track. And the political thing is one of them. And so we try to ignore all of that sort of thing and stick to a basic fundamental strategy and concept. And that, I think, will serve us, has served us well, and will continue to do so. But it is part of the news and the drama. And I think we have to fight to make sure it doesn't influence our decisions in a way that's going to hurt our long-term performance.
Yeah, absolutely. And that's probably a good segue into the next topic, which is focusing on the fundamentals. Everything that I just mentioned here about what went on in the first half of the year, what might go on in the second half of the year, none of that influences our investment strategy and what we do from portfolio management, because if we tried to manage money based on short-term information, I can almost guarantee that would be a disaster. So we really do focus on the long-term and fundamentals. This here just shows and proves that most years in the market are positive. And, good markets, good times last in much longer duration than recession times or bear markets. So this chart goes back from 1970 all the way up to 2024. And, in that time period, it shows there were many bull markets. So as a reminder, bull markets are markets that are on an upward trend. And on average, those lasted about 76 months. So, pretty long and healthy. And then the average bear market, when we're not in the uptrend, we're in the downtrend, the average duration was 15 months. So just knowing that being in the market, staying invested, your odds are is that you're going to be likely earning those average rates of return as long as you just stick with the strategy and ride out those bear markets and those poor return trends. Investing fads, this is certainly worth mentioning as well. Herd mentality, you might be familiar with, jumping on a bandwagon, trying to miss out on whatever the latest and greatest is, and going back in time, there's been many of them. Kind of some of the more recent ones were the big internet bubble back in the year 2000, 2001. Of course, the housing rise and fall back in 2007, 2008. Biotech, which was more around 2015, 2016. FANG stocks, Facebook, Apple, Google, all those big tech companies, the rise. We haven't really seen a big fall, but definitely a theme area of investing. And right now, just cropping up is AI. And so we're going to be seeing a lot more of that. Themes, I know, is something that we don't jump on board with. We stay true to who we are and how we invest, and taking a risk management approach while trying to achieve, solid rates of return over time. And so I'm going to turn the floor to John and Greg to talk about strategy and what we've been up to lately.
Right, John, do you want to kick it off or?
Well, I would kick it off by saying this, and that is that we adhere to a rigid and strict discipline that we believe in. We don't style drift, and that's a term that we use in the industry for money managers who might shift what they're doing to maybe more popular type of investments to try to capture short-term swings in the market so that they're not left behind. And I think that we have the capacity on Common Sense Investing to sit back, recognize that it's not in our advantage to try to knee jerk on anything. Literally everything that we do is slow, methodical, and tweaking in nature. And I expect that that's the way we're going to keep it for the most part. Greg, you could talk more about valuations, and you're very familiar with that, but basically we're going to buy a diversified portfolio. We're going to build for clients. It's going to be somewhat targeted with a small amount of the capital. In other words, if we feel that small company stocks are a better value than large company stocks, we might tilt more of the assets in that direction. If we feel that international investing is more attractive, we might tilt it, but we don't do a complete reconfiguration of a portfolio, because as we can see, based on the presentation that Sheena's providing here, that if you try to predict the future, you might end up really doing a complete disservice to the process of trying to manage money. So we'll stick to our methodical, tweaking, slow moving approach going forward.
Yeah, well, like the slide says, you know, we're value investors, and, you know, we use a value approach and we want to stick to it and not style drift, like John says. And we feel that, you know, we know that proves to be a successful strategy over time. We've been going in and looking at our buy list. We've been buying, you know, or putting companies on our buy list that have lower PE multiples, price to earnings, that have lower debt to equity, because in the higher interest rate environments, the longer that the interest rates do stay higher, that, you know, puts pressure on company profits, which can affect their performance. So we like companies with lower debt. And then price to book, which, you know, basically looks at a company to see what its, you know, underlying value is really worth when you take the assets and subtract them from the debts. So we're looking for companies that, you know, have a low ratio. And we feel that that's going to pay off over time, because at some point with the market trading at a multiple of, you know, depending on which metric you look at, forward or, you know, current and stuff, but you got a multiple of about 21 PE. We're looking at companies that are more in the range of 15, more historical ranges. So we think that there's value there. And then the other thing that we do is we're going to look at areas and asset classes that we feel are undervalued, like small caps, mid caps, and international stocks. And we're going to, you know, probably, you know, commit more of the capital to those areas. Excuse me. And, you know, we're going to keep the current accounts that we have built in line with those values, and keep them fully invested, because we understand that, you know, we try not to do the market timing. You know, sometimes with new money of new clients and stuff, you get into that a little bit of trying to re-enter the market. But with established clients. We want to keep them fully invested. And, we will be patient with the cash that we do have on the sidelines and till valuations come down and look a little better.
Mhm.
Sheena, we
Yeah.
could we could almost rename value investing to boring investing, because you look at things that do not excite you. And the
Yeah.
opposite of value investing is what we refer to as growth stock investing. And those are frequently and more often than not theme stocks, about trying to predict which particular product or concept is going to be the theme of the future. And then in addition to that, if you're going to try to be a momentum investor or a growth stock investor, not only do you have to identify the theme that's going to last, but you have to try to figure out which company in that space is going to survive. And the best example I can think of is back in the 30s, there were over 300 automakers. And everybody could see in the 30s that the automobile was going to be, a big growth industry. They weren't going to continue, with horses when you have cars available to you. But then there's 300 companies out there, and you have to figure out which one of the 300, and there were only 3 that survived. We don't think we're good at doing that, but we think we're pretty good at buying these boring companies, and trying to, it's like trying to buy a house on the cheap. Try to get a good deal. We're always looking for good deals. And we're not willing to overpay for anything, particularly if we don't understand the theme and we know the unlikely prospect of getting it right. Not to mention volatility that's associated with portfolio management.
Yeah, one other thing that I guess I'd like to bring up, and we'll just talk a little bit about, the markets looking pretty good so far this year. And, but when you look at the equal weight, the performance just is not there. And you have that disparity right now, and that's part of being patient is, when you have the S&P 500 being up a little over 17%, but then you have the equal weight being up about 4%, which is what a lot of, stocks are getting right now, or where they're at. You got to be patient, and sitting in cash sometimes seems like you're not doing very well, but cash right at the moment is paying, about just short of 5%. So you're not missing out on that much on a, and especially on a risk adjusted basis, sitting in the cash is not hurting as much as what it may seem if you're a value investor.
Mhm.
Well, one other thing, for the benefit of those people who are watching this program, is we need to define a little bit about the S&P 500 and the equal weight versus the S&P 500. And what basically Greg is saying is that the S&P 500 is highly weighted based on the size of the corporation. And so huge corporations can influence that index. But equal weight means you take the 500 companies in general, and you find that there's been a very, very small segment of the market that's pulled the weight as far as the returns. And if you're not in that segment, you're not getting those returns. And the vast majority of investors are not in that segment.
Thank you for your comments, guys. We continue to do our best that we can do for our clients around here, taking money management approaches that we think really is best for everyone. So the stock market can be a surprising thing. We don't know when the next recession is coming. It's always a surprise. And the reason as to why that happens, what causes a recession is always a surprise. And so we're just going to keep continuing to do what we do around here, make refinements as we see necessary. And it'll be interesting to see what plays out the rest of the year. That's really all I had in terms of final comments. I don't see any questions in the question and answer poll, but if anyone does have any questions that they want to take off of the webinar or have a one-on-one discussion, please let us know. Again, we are going to be sending out this recording. So John, Greg, do you have any final comments from today?
Well, not really, just the fact that we've, based on what you've shown us here, we know we can't predict, we're not going to try to predict, but we are going to feel very confident with our ability to deal with the events as they unfold going forward.
Great. Well, thanks for joining me today.